right, good evening, everyone. Thank you for joining me today. My name is Kim Heffernan, and I am a financial advisor with Northwest Financial Advisors. We are a wholly owned subsidiary of Northwest Federal Credit Union, and we specialize in comprehensive financial planning and investment management services. So we work with you really to assist in reaching those financial goals that you have. Women now more than ever are the primary money manager of their household, whether that's a single household or a joint household. And women can view wealth and financial planning differently than men do. With this industry being primarily made up of men, there can be some discrepancies between the advisor or the planner and the client in terms of how they think, how we work towards financial goals. So today we're going to go through some of the information specific to women and challenges that we may face on our own or in a couple, as well as some financial planning scenarios to illustrate some of the conversations that we're having with our clients and provide you an idea of what we as planners and advisors do and how you might be able to benefit from this type of relationship. We do have some housekeeping before we get started. There are some troubleshooting guides in the handout section of your dashboard. If you're having any trouble seeing the slides or myself or with the audio, we're going to go through the slides and then open up to questions after that. So questions can either be emailed to me. We'll have the address up there at the end, or if you have access to a microphone, you have the ability to raise your hand as well, and we can unmute your profile. Lastly, the information contained in this presentation is for educational purposes only. It's not intended to be a substitute for specific individualized advice. We do recommend that you consult with your or a financial advisor for guidance specific to your unique situation. Please also be advised that this presentation is being recorded for the purpose of sharing the content after the webinar, but all attendee questions will be removed from the final recording before it is distributed. So with that, we will go ahead and get started. So we're going to kick it off with financial planning. The words are kind of thrown around a lot, but really what does that mean? So overall, to us and to our organization, you have different goals throughout your lifetime from a financial standpoint that we might want to save for. So an ultimate goal for most is likely going to be to save enough money over our career so that one day we don't have to work anymore if we don't want to. We can live off of that savings, or if we are unable to go back to work on Monday, so that we can maintain our quality of life. Then we have other goals that may be more shorter term and different for everyone. So how do we manage those savings for all of them so that we can be successful kind of across the board? We want to determine how much we need to save for them and what that means for us long term. So as financial planners, we're working with different strategies to figure out what works best for you. So here we have the median prices in the DC metro area for each of these kind of big purchases. As the financial need gets larger, ideally, so does the amount of time that we have to save for these goals. But because of that, it can be easier to focus on more immediate, more short-term goals first. They may be smaller, more simple to address. But if we are to do that, then what effect does that then have on our longer-term retirement goal? So what we want to do throughout these conversations is address the more complex needs first and then prioritize accordingly after that. So in most situations, retirement is going to be number one. So what, if anything, can we do to make that goal a little bit easier to reach? And we may look at college savings, depending on if that's part of our plan, how old our children are, our philosophy around funding higher education, a new house, a second home, a new car, fitting everything together to make the best decisions along with you. So one thing you may have noticed here is that this goal of retirement does not have that kind of average dollar amount. And this is because retirement looks completely different for everyone. We really can't put a blanket number on it. That kind of magic question of how much money do I need to save to retire is really answered with another question, and that is, well, how much do you want to spend? How much do you need to live, right? So we build up all of these retirement assets and our savings so that we can draw income from our TSP or our IRAs or our 401ks. So if we want to draw, say, $40,000 per year from those savings, we're not going to need to set aside as much as someone who would like to draw $100,000 from those assets. So part of the planning process is we're making some of those assumptions based on your income levels and what makes the most sense for you. So once we have began to think about what these goals might be, what they could look like for us, we can put that plan together of how we are going to reach them. How are we going to get there? And like I said, every person's plan is going to look a little bit different. But here we have some common financial planning challenges that can affect everyone, but can also have a greater effect on women in some situations. So we want to take a look at how becoming more aware of our situation, what challenges could come about if we're not already, of course, can help us to find the right questions to ask, the right strategies to use to help us to reach those goals. To cover a broad range of these challenges, we kind of have three categories here. So we have unpredictable life events, we have economic realities and retirement planning hurdles, and then we have the fear of making a mistake. So studies have shown that 9 out of 10 women will be solely responsible for their finances at some stage in their lives, whether that is a new situation due to a divorce or a death of a partner or not. If this is a new situation, it can be a traumatic transition. A divorce or a death are just as much financial events as they are emotional events. So if you're not the person who primarily takes care of the financial side of the family, we want to start to become comfortable with the assets that we have, where they're held, what they are, what they're invested in, to help to make a smoother transition. Those are some of the things that we would want to consider there. How are the assets titled? What companies are they held with? Who are the beneficiaries? What would happen in the event of either your passing or a spouse or partner's passing? You also want to look at your tax situation. A married couple is seen as one person in the eyes of the IRS. So is that going to change? Or how do we take advantage of and adapt to this new situation, or take advantage of the situation that we are in? If we are the sole manager of our household, are there any other strategies that we can implement to take advantage of different tax situations or different savings options as well? Looking at illness as opposed to death or divorce, depending on what costs are covered by health insurance, a serious illness of either yourself, a family member, a partner, can cause a huge detriment to our financial assets. So we would want to look from a planning standpoint, really no matter how far away it is. Are there illnesses that run in the family that we should potentially plan for? Do we have longevity? Should we purchase some sort of long-term care insurance, life insurance, or are we in a situation that we could potentially self-insure? How does that fit in along with the rest of our situation? Moving into the next column, the more economic side of things. Although wages are rising, according to the U.S. Bureau of Labor and Statistics, on average, women are still earning nearly 20% less than men do for the same job. So when we're thinking of this in terms of retirement savings, we may not be able to put as much away into our 401ks or other savings plans to maintain our quality of life now as someone that is earning higher wages. Vanguard Research did a study that took a look at all of the workplace retirement plans that they manage in relation to the participation rates, the earnings of those participants, and the investment choices. And their research did show that women and men have similar participation rates in those workplace savings plans, but overall, men's account balances were more than 50% larger than women's, and this correlated to the difference in wages. So it did show that men and women are taking similar levels of portfolio risk, but that men are more likely to hold more aggressive equity allocations, more stocks, more likely to trade, more likely to make adjustments in those accounts. So with this awareness of kind of our position and what we could be doing, what are we able to do now and implement to further our savings to help reach those goals? And that's what we want to get into today. Another hurdle that we may have worked through is the consideration of taking time off from work to care for aging parents or children of our own. Is this feasible for your family from an income standpoint? Maybe yes, but potentially not. What does that effect have on us personally, mentally, but also from a financial standpoint? Also from on the financial side, from the retirement savings standpoint, there's generally going to be some sort of break-even point between the income coming in, the cost of daycare or elder care. So exploring what options we have and make the most sense for you. Lastly here, in addition to these lower income levels, another reality is that women tend to have longer lifespans. So when we're thinking about this in terms of that long-term financial plan, looking at that longevity, does that mean that our savings is going to have to last that much longer? And does that mean potentially having to work later in life than maybe we want to or are planning to at this point? We generally want to plan for a retirement period until age 95, but really looking through those numbers and what that means to you can allow you to plan for a retirement period, whether that's 20 years or 40 years long. Last column here, moving into this, the last column of challenges, there is this kind of an overarching lack of knowledge of the financial services industry in general, no matter who you are or how old you are. And this can cause a lack of confidence in wanting to invest, as well as the tendency to be too conservative if the decision is made to invest at all. And that's part of what was shown in the Vanguard study. There's absolutely the factor of the unknown in the markets, especially when we're having such volatile time periods like we are right now. But all of these challenges are something that can be discussed and overcome with good planning and with resources and people that you trust. All right, so in general, like I said, whether young, old, whoever you are, a great place to start is by building this investment confidence, getting more engaged with what our assets are invested in and what that looks like from a financial standpoint. So really figuring out where to turn to, who to ask questions to. A financial planner is really here to be a resource to their clients. We want to help educate. We want to work through situations. We want to assist you in that decision-making process. So even if you don't feel like you need a planner at any stage or whatever stage of life you are at right now, even just a conversation could bring about things that hadn't maybe been thought about before and are now things that can be solved or made into goals for your long-term plan. Starting that relationship, building trust with someone. Then if something were to happen, we don't know what tomorrow brings, we have someone to turn to that is familiar with our situation. We speak with people every day who are in new situations and are needing to find that comfort and awareness of really how to move forward. The last thing on this slide here I wanted to point out is just this statistic about being underinvested. A percentage of women are generally inclined to pick the most conservative portfolio allocation, and whether that's because of investor confidence or because of a level of comfort with risk, that's one of the most important pieces to make sure we are invested appropriately. So researching the investment options we have within a retirement plan, making those decisions can exponentially help the success of our plan in the long run. So part of this directly relates to why we want to address these challenges, manage our goals as early as possible. We want to continue saving for them no matter how far away they are, due in part to something called compounding interest. So the longer we are able to make those monthly contributions to the 401k or the college savings plan, the more time that your money has to work for you and invest and potentially provide growth to you for the future. So we're going to go through a few calculations here, how we approach kind of two common financial planning goals. The first we're going to start with is retirement. So we're looking at a few pieces of information to really determine retirement readiness, no matter how far away it may be. When we're thinking about retirement, we want to have income, right? We want to be able to get a paycheck from somewhere when it's no longer coming from an employer. So that is going to be different for everyone, but generally we have kind of 2 or 3 main sources of income in retirement. The first is that we have our savings, we have our 401ks, we have IRAs, we might have other investment accounts or savings. We're going to have access to some sort of Social Security income at some point in the future. And then we may have access to pension income that we would be eligible for through our employers. So based on that amount of savings that we have right now, we can estimate how much income that could generate for us in the future, whether that is at age 55 or 65 or 75 or whatever that means for you. So here we have Alyssa. She is 55 years old. And she is planning to retire in 12 years. She wants to begin using her savings then. So right now, she currently makes $110,000 before taxes. And in retirement, she thinks that she can sustainably live on around $85,000 of income. So we usually want to plan to have available income of around 80% of our pre-retirement income in retirement. Expenses generally decrease. We may not be contributing to our retirement plans anymore. We're not paying into Social Security any longer, and we might move to a different location. We have lower cost of living. All of those things kind of play into that ideal retirement income number. So for Alyssa, between her Social Security and a pension that she's going to receive from her employer, she's going to receive around $45,000 per year before taxes. So then we have this gap. So we have an annual income gap of around $40,000. And this is what we're looking to generate from the savings that she has. Now the question becomes, can we do that? Is that feasible for her and for where her position is right now? So right now she has $700,000 saved in her employer 401k, and we're going to estimate that she's going to be in retirement for 28 years, so until age 95. Using this information to draw $40,000 for 28 years, she would need about $1 million saved at her retirement date, given some assumptions. So right now she is at $700,000. But she's planning to work and continue contributing to this plan for another 12 years. So between her contributions and the employer matching, she's currently saving $18,000 per year into the 401k. And we're going to assume that these investments have an average return of 5%. So in 12 years, if that's the case, her balance could be about $1.54 million. So at the rate she's saving right now, she's going to have more than enough to meet her goal of only needing $1 million to sustainably draw $40,000 per year until age 95. So once we kind of have this base, the conversation then becomes, well, now you have options, right? So if you continue doing what you're doing right now, you're going to more than meet your goal. So do you want to work 12 more years? You might not have to. What if we only work 10 more years or 8 more years? What do the numbers look like then? Or maybe you want to have a little bit more fun in retirement. You're fine working for 12 more years as long as you're able to do so. And you want to have access to that extra income to take an extra trip or do whatever is important to you at that time. The other side of it is maybe we lessen our contributions. We take home more income now so that we can have more fun now. And what does that look like from a planning standpoint? So this sort of situation with our clients is ideal. We want to be able to provide options. What can we do now so that in 10 or 20 or 30 years, when retirement comes around, you have this sort of flexibility so that you can retire earlier if you want to, or you have the flexibility to do so and with what the future holds. So a secondary goal could be saving for higher education expenses. So for any children, grandchildren, anyone that you'd like to help or hope to help go to school through 529 college savings plans. So this calculation, we have Michelle. She has a new child, and she wants to see how does this fit into her plan. If we were to save for them to attend Virginia Tech in 18 years, what would that look like? So we look at data a bit differently for this type of goal. We want to look at what would you need to save each month to be able to fully fund education. So right now, 1 year at Virginia Tech costs just under $27,000, and to fully fund 4 years at that future price, we're going to assume that this cost of college increases at 4% per year, and any investments in a 529 college savings account average about a 6.5% return within that account. So to fully fund 4 years, it's just under $202,000, and that would require a monthly savings of $395 per month for the next 18 years to be able to cover those tuition payments. So this way of looking at it is really just a starting point to see how can we use this information to fit into your plan and find a balance between your savings goals. So am I able to save this much per month? Do I want to? Do I want to fund 2 years or just set aside what I'm able to do so, and that's what they will receive. So there's some philosophy to be discussed around funding higher education, a little bit different than retirement in that we generally want to address that retirement goal first. But with the rising costs of college, it is absolutely something that we want to work through and work into that plan if that is something that is important for us to allocate our savings towards. So in both of these calculations, we have assumed that the retirement accounts and the college savings accounts are invested. They have market exposure and they are receiving a stated rate of return. So in the retirement accounts, we assumed 5%, and in this 529, we assumed a 6.5% rate of return. So that is really an integral part of these calculations. If we did not assume that, then these numbers would look vastly different. So now we want to look at kind of the investing side of the planning and how do we position our money in different types of investments and different types of accounts so that we can take advantage of market cycles and have our money working for us the best that it can be. So high level, just kind of a broad overview of different types of assets is we generally look at them as having an investment objective. So when we're determining the goals that we have with our money, we want to see how should we allocate this money. We can strive for growth in the assets, which would be taking on more risk for a potentially higher return. We can take a more moderate approach, kind of more middle of the road, striving for some growth, but also some conservation. We don't want to take on as much risk, or being conservative, have that conservation allocation in the assets, taking on very little growth potential, but really trying to preserve the value of those assets instead of taking that risk. So the appropriate investment objective is going to be determined by your specific situation, how much time we are looking to invest for, how comfortable we are with market volatility and market fluctuation, and what we're ideally hoping to use this money for. With any sort of monies that we have, there's different types of accounts that we can invest in, which are separated primarily by their tax treatment and what they're ideally going to be used for. So first we have the taxable accounts, which would be like an individual or a joint non-retirement account or a brokerage account, bank accounts that are earning interest. These accounts have tax implications each year called capital gains or capital losses or taxable income. And it is determined by the interest that's earned or the investment returns or sales that occur in those accounts. We also have tax deferred accounts, which are your traditional retirement savings, like traditional 401k, traditional IRA, 403Bs, the traditional TSP. When contributions are made into these accounts, you can receive an income tax deduction for making that contribution. So it helps you lower the amount of taxes that you pay now. Those get invested. The earnings can grow tax deferred. So when the funds are pulled out of the account in retirement and used, a distribution is taken, that full amount is taxed as income to you at your future income tax bracket. Lastly, we have tax-free accounts or after-tax accounts, which would be a Roth money, Roth 401k, a Roth IRA, the Roth portion of the TSP, and these are treated as post-tax. So contributions are post-tax. You do not get any income tax deduction for making that contribution now, but that money gets invested or can get invested and can grow tax-free. So when you take a distribution, when the funds are pulled out and used in the future, that distribution is completely tax-free or can be tax-free. There's no taxes owed on that amount at that time. So when we're looking at our plan in our picture, we do like to see different types of money, different types of accounts. And that's because each type of money can be used in different ways, whether that's throughout our lifetime or once we get to retirement. We want to look at each year, if we need a distribution, what's most tax efficient at that time? Or should one specific account be used towards a home down payment or college savings, or how do we fit that together so that we have as many options as possible when we need to take that distribution so that we can be as tax efficient and take advantage of all these different types of accounts. Lastly, on this slide, we have the kind of four different basic types of assets. So in any sort of investment account, you can invest in all different things. Here, high level, we have four. We have equities, which are stocks that can be in U.S. companies, stock holdings in international companies, specific sectors of the economy like financials or technology companies. We have fixed income, which is the bond markets, so government bonds, municipal bonds, private company bonds. We have alternative investments like real estate or commodities or hedge funds. And then we have cash. So depending on the type of account that we're looking at and the goals that we have in that money, the decision can be made on what type of investment objective do we want. What does that mean in terms of holding stocks versus bonds versus cash, or a little bit of everything? In the portfolios that we manage, and most likely what's in your employer 401ks are mutual funds. So a mutual fund is basically a portfolio. It's a portfolio built up of positions in all of these different asset allocations. So instead of choosing individual stocks or individual companies to invest in, there's holdings in the mutual funds that are managed by a mutual fund manager. So what you're able to do by holding that one individual mutual fund or a few different mutual funds is access thousands or hundreds of different stocks and bonds all within just a few holdings. So it's a means of diversification, which we will get into on the next slide. So here we have three important things to consider when we're thinking about investing or in different account types, and considering how much risk we're comfortable with taking. So the first is the inflation factor. So over long periods of time, like a career or a lifetime, money loses its purchasing power due to inflation. So there is absolutely risk in investing in the markets, but there's also risk in keeping too much cash as well. So inflation is a hot topic right now with the point that we're at in this market cycle. But long term, we want to take a step back, look at the long-term picture. The Fed's target average rate of inflation is anywhere between 2 and 3% per year. So if the assets that we have are not invested in or receiving interest and earning equal to that or more, we're essentially losing value in your assets. We're reducing our ability to purchase the same amount of goods today and in the future. So this is one of the reasons the investment choices are so important, and really making sure that our portfolio is allocated correctly. We don't get too conservative too quickly, or just keeping in mind the goals and the timeline that we have for those goals. Here we have diversification. So diversification is a technique which attempts to reduce the overall risk in the portfolio by investing in a variety of different asset classes or types of assets or regions around the world. So basically, by kind of not having all of our eggs in one basket, we don't have all of our life savings in a single stock or something like that. So there might be opportunity to have exposure to all different types of companies and all different types of investments. So we have a little bit of international, we have a little bit of large US companies, some small US companies, some fixed income. We're able to take advantage of those different things performing differently at different times in the market cycles. So mutual funds help you to do this because you can hold so many different things within the individual mutual fund. So there's a time and place for both, but it's just something to consider. Lastly, here we have the risk profile. So risk factors, which we touched on a bit, but really understanding how much risk we are willing to take in our investments. Generally, there's kind of 5 risk classes underneath the 3 investment objective qualifications. So we have conservative, we have moderate, a balanced, growth, or aggressive. So the higher rates of return on aggressive or more growth-focused, risk-focused investments can be more appealing when we're looking at those long-term averages. But when we have volatile situations like we are experiencing now, are we comfortable with the fluctuation in the account balance or what's happening right now? So we're looking at our level of comfort with risk, but we're also looking at that timeline on the investments. So if we have 30 years until retirement, maybe we can take on a little bit more risk. If not, maybe we go a little bit more moderate, more conservative. It all depends on how we want to take advantage of our different types of accounts and different types of investments. So another part of our financial planning process does include estate planning, determining how to own and protect our assets. So we have included here 5 documents that you might consider having on file from an estate planning standpoint. It's all part of kind of that big picture financial plan and making sure that we are able to understand and know what is going to happen if something were to happen. So we have a will. All physical property or real assets should be in the will. So who you would like any belongings to go to. Basically anything with a dollar sign, checking, savings, TSP, 401k, brokerage accounts, can have a designated beneficiary or a TOD or a POD, which is transfer on death or pass on death. So this is a form signed by you that binds the institution to pass the account to whomever you have designated on that beneficiary form. So if there is no beneficiary designated on financial accounts, they will most likely go through probate. So making sure that those beneficiaries are up to date and how you intend them to be, both primary and contingent, is a really easy place to start the financial planning and the estate planning process. Then you can have kind of a catch-all provision in the will for any of the financial accounts to help for any sort of smoother transition. A healthcare proxy appoints someone to make healthcare decisions on behalf of you if you are unable to do so. Similarly, a power of attorney or a durable power of attorney allows you to appoint someone to act on your behalf outside of just medical scenarios. So you can have a general power of attorney, which would allow that person to act in a broad range of matters, buying and selling real estate, managing finances, taxes, things like that. You can also have a limited power of attorney that would only give them authority to handle a specific situation. Guardianship provisions, if there are any children, who should they be left in the care of, or what should happen there. And lastly, we have a trust. So a trust is created basically to control the assets after you pass away. So there are specific situations where a trust is necessary. Depends on your intentions. So do you want a portion of the assets to be paid to your beneficiaries each year until they're gone? Do you not want someone to have access to an IRA until retirement or until they graduate college or turn 30? Trusts are a great estate planning tool. They're not required for everyone, but it's a good conversation to have and see if there's some sort of transfer of assets that we should outline in a trust document. Having beneficiaries on everything can take care of most of the initial transfer of assets for a simple situation, but as we go through our lifetime or our plan, it may come about that a trust is necessary for you and your family. So these last few slides here are really a resource for you. Some ideas to have when we are considering working with an advisor. It is a personal relationship. All financial advisors and all firms can run their business a bit differently. There's different fee structures available. They use different types of investments. We have different qualifications and really just overall services that they may offer to you. One is not necessarily better than the other by any means, but you do want to find somebody that you feel comfortable with. Here we have 10 potential questions to ask a financial advisor. They're great questions to consider just to get a feel for what type of firm they are, what kind of services that they offer. This is our view of the comprehensive financial planning that we do and really what it entails, and those are the points that we touched on today. We want to review our accounts and our plan with an advisor to really make sure that we're keeping everything on track. That's what we're here for. We want to use the foundation of your life as your financial plan instead of your 401k or your savings account. We want to really bring everything into that comprehensive, holistic perspective and put that strategy together to help you be successful long term. So we will open it up to questions in a moment, but if anyone does have to go, we do offer complimentary consultations to anyone that is interested virtually in our main office in Herndon and also the branches of Northwest Federal Credit Union. Myself and my colleagues Nikki Young and Todd Holden, we cover different branch locations of the credit union and are available to meet in any of the locations that are most convenient for you.